Thank you, Melissa.
Thank you, Karen.
I was thanking you, too. I was thanking both.
We start off with sea of red on Wall Street. Stocks taking a sharp turn lower midday with the S&P tumbling over 1.5% and the Dow losing 816 points. The small cap Russell 2000 leading the losses down almost 3%. The catalyst, a spike in bond yields triggered by a disappointing 20-year Treasury auction this afternoon. Weak demand sending rates in the benchmark 10-year briefly above 4.6% during the session, their highest level since February. 30-year hitting its highest since late 2023. Meanwhile, Bitcoin, that hit fresh record highs for the first time since December, getting within a stone's throw of 110 before pulling back from those levels. And gold also higher, up now for a fourth straight day. So what was this all about, Tim?
This was one of those days that felt really important, and the price action, it was the most volatile day we've had in a month for an equity market that's been on a tear, and there's some questions about maybe Apple, and so there's kind of existential stuff out there when it comes to global bond yields. A 20-year auction that, like, a lot of people probably didn't even know we had a 20-year bond. In fact, this was an auction that was only brought back to life about 5 years ago. It was a $16 billion auction, but more importantly, it was the lack of demand. It was the fact that a coupon settled in over, started out at 5%, and yet dealers took almost 17% of this issue, which is a lot. It comes after we've had significant backup in yields in Japan. It comes on the eve of a budget being pushed through that has a big tax cut in it. Whether we already had that tax cut or whether it's a new tax cut, it doesn't matter on the politics. The credit folks are telling you one thing. And in fact, I think even Moody said that, whether people want to listen or not. So it's been a very interesting few days. We all debate all the time. What's that breaking point for equities in terms of bond yields? We closed at that intraday high of where we were on the day. It seemed like the Trump administration blinked on the bond market, not the stock market. So what do you have? An S&P that fell almost 80 handles immediately after that auction. Interesting day.
Yeah, strategist after strategist, 4.5%. That's a cap for equities in terms of how high we can go. Here we are, 4.6% firmly, Joe, and that has proven to be an issue.
I think one of the things that creates a lot of agita in the marketplace is we seem to settle down a little while ago when Trump made it clear that he's willing to negotiate as far as tariffs go. But we still have issue with regard to taxes, what's going to happen there. We still have an issue with regard to the budget. We still have an issue with regard to deficit. So if you have a failed auction, all that means is that ultimately we're going to have higher expenses for our debt, and is already close to $1 trillion. If you look at increased expenses for your debt, you don't have a whole lot of room left over for discretionary spending to cut that. So that raises, I think, major issues in the mind of the marketplace.
Right.
Yeah, I think we all saw that sell-off, dramatic sell-off, dramatic rally back. This is just a breather zone. If we stay stabilized above 5,500.
Haven't you been the one who said Treasuries over 4.5%?
Yeah,
you have been among that chorus of people saying 4.5% is an issue.
Yeah,
we're at 4.6% right now.
Yeah, that's why I said 5,500 in the S&P. If we stay above that, so I think we're going to draw down a little bit based on that. I also feel like we could run to that 6,000 level again. I had put that a couple of weeks ago on the desk. I said 4 to 6 months. We did it basically in a month to get back to that level. Too fast on the way down, too fast on the way up. If we could stay middle 5,000s, I think that's a win.